Welcome to our section on Introduction to Credit Scores. Credit scores play a crucial role in our financial lives. They are numerical representations of our creditworthiness. Lenders use these scores to decide if they will lend us money and what interest rates to offer. A higher credit score often means better loan terms and lower interest rates. In the United States, the most commonly used credit scores are FICO scores. These scores range from 300 to 850. A score above 700 is generally considered good, while a score above 800 is excellent. Factors influencing these scores include payment history, amounts owed, and length of credit history. Understanding how different types of debt affect your credit score is essential. It's not just about how much you owe, but the type of debt and how you manage it. This essay will decode the impact of various debts of your credit score. Let's dive into the world of debt and credit scores. Moving on to Section 2, Importance of Credit Scores. Credit scores influence many aspects of your financial life. They affect your ability to get loans, rent apartments, and even secure certain jobs. A high credit score can save you thousands in interest. Lenders see high scores as a sign of reliability. Good scores lead to favorable terms and lower interest rates. Conversely, a low score can be a red flag for lenders. This might result in higher interest rates or loan rejections. Maintaining a good credit score is essential for financial health. Let's talk about student loans and your credit score. Student loans are common among young adults. They can significantly impact your credit score. Paying on time positively affects your score. Missed payments can severely damage it. Loans have long repayment periods. This helps build a long credit history. High balances might negatively impact your score. Federal loans offer flexible repayment options. Private loans might not, making timely payments challenging. Always aim to pay on time. Consider income-driven plans if struggling. Lastly, we'll discuss Section 4, Mortgages and Credit Scores. Mortgages are one of the largest debts many people will take on. They can significantly impact your credit score. A mortgage shows that you can handle large amounts of debt responsibly, which can positively affect your score. Timely mortgage payments are crucial. Each on-time payment can boost your credit score. Conversely, missed payments can severely damage it. Mortgages also add to your credit mix, which accounts for about 10% of your credit score. A diverse credit portfolio can be beneficial, however, the size of the mortgage affects your score too. A high mortgage balance can initially lower your score. Over time, as you pay down the mortgage, your score can improve. The length of your mortgage also helps as it builds a long credit history. To manage your mortgage debt effectively, always make payments on time. Consider setting up automatic payments to avoid missing due dates. Over time, your mortgage can become a positive factor in your credit score. Credit cards are one of the most influential types of debt on your credit score. They affect several key factors of your score, including payment history and amounts owed. Responsible use of credit cards can significantly boost your credit score. Payment history is the most important factor. Making timely payments on your credit cards can positively impact your score. On the other hand, missed payments can severely damage it. Another crucial factor is credit utilization, which is the ratio of your credit card balances to your credit limits. Keeping your credit utilization below 30% is recommended. High utilization can negatively affect your score. Additionally, the length of time you've had your credit cards can also influence your score. Older accounts with good payment history are beneficial. To manage credit card debt wisely, always pay on time and keep your balances low. Avoid opening too many new accounts at once, as this can hurt your score. Responsible credit card use can be a powerful tool for maintaining a good credit score. Auto loans are another common type of debt that can impact your credit score. Like mortgages, auto loans can demonstrate your ability to manage large debts responsibly. Timely payments on your auto loan can positively affect your score. Auto loans contribute to your credit mix, which can be beneficial. They also help build a long credit history if you have a multi-year loan. However, the amount of the loan can initially lower your score, especially if it's a significant portion of your income. Missed payments on auto loans can severely damage your credit score. It's essential to make all payments on time. If you struggle to keep up with payments, refinancing might be an option to consider. Lowering your monthly payment can help you avoid missed payments. Managing an auto loan effectively involves making timely payments and considering refinancing if necessary. Over time, a well-managed auto loan can become a positive factor in your credit score. Personal loans can have a varied impact on your credit score. These loans are often used to consolidate debt or finance large purchases. How you manage a personal loan can significantly influence your credit score. Timely payments on personal loans are crucial. Just like with other types of debt, late or missed payments can severely damage your score. Personal loans also add to your credit mix, which can be beneficial for your score. The amount of the personal loan can affect your credit score too. A high balance might lower your score initially, but paying it down over time can improve your score. Additionally, personal loans can help reduce your credit utilization on credit cards if used for debt consolidation. To manage personal loans wisely, always make payments on time and avoid taking out more than you can afford to repay. Consider using personal loans for debt consolidation to improve your credit utilization ratio and overall credit score. Section 8. Medical debt and credit ratings. Medical debt is unique compared to other types of debt. It can arise unexpectedly and often leads to significant financial stress. Medical debt can impact your credit score, but there are some protections in place to mitigate its effects. Unlike other debts, medical debt often has a grace period before it appears on your credit report. This allows time to negotiate with healthcare providers or insurance companies. However, once it appears on your report, it can lower your score. Paying off medical debt can be challenging, but it's crucial to avoid it going into collections. Debt in collections can severely damage your credit score. Some newer credit scoring models give less weight to medical debt, but older models still penalize it heavily. To manage medical debt, try to negotiate payment plans with healthcare providers. Review your medical bills for errors and make sure your insurance has paid its share. Keeping medical debt under control can help protect your credit score. Section 9. How debt mix affects scores. Your credit mix, or the variety of debt types you have, makes up about 10% of your credit score. A diverse mix of debt can positively impact your score. This includes a combination of credit cards, mortgages, auto loans, student loans, and other types of credit. Having a mix of credit shows lenders you can manage different types of debt responsibly. It indicates financial stability and reliability. However, it's important not to take on unnecessary debt just to diversify your credit mix. Each type of debt should serve a purpose. For example, a mortgage and an auto loan provide long-term credit history. Credit cards show your ability to manage revolving credit. Student loans and personal loans demonstrate your ability to handle installment loans. A balanced mix can create a stronger credit profile. To optimize your credit mix, aim to have a variety of credit types. However, focus on managing each debt responsibly. The goal is to show a pattern of responsible borrowing and repayment across different types of credit. Section 10. Strategies for smart debt management. Managing debt smartly is key to maintaining or improving your credit score. One effective strategy is to always make payments on time. Set up automatic payments or reminders to avoid missing due dates. Timely payments are the most important factor in your credit score. Another strategy is to keep your credit utilization low. Aim to use less than 30% of your available credit. This shows lenders that you can manage your credit responsibly without relying too heavily on it. Paying off credit card balances in full each month can help achieve this. Diversifying your credit mix is also beneficial. Having different types of debt, like credit cards, mortgages, and auto loans, can positively impact your score. However, only take on new debt if it serves a purpose and you can manage it responsibly. Lastly, regularly check your credit report for errors. Mistakes can negatively impact your score. Dispute any inaccuracies you find. Keeping an eye on your credit report helps ensure your score accurately reflects your creditworthiness. Section 11. Conclusion, boost or bust for your credit score. Understanding how different types of debt affect your credit score is crucial. Each type of debt, student loans, mortgages, credit cards, auto loans, personal loans, and medical debt, impacts your credit score differently. Managing these debts wisely can lead to a better credit score. To boost your credit score, always make payments on time, keep your credit utilization low, and diversify your credit mix. Regularly monitor your credit report for errors and dispute any inaccuracies. These strategies can help you maintain or improve your credit score. A high credit score opens doors to better financial opportunities. It can lead to lower interest rates on loans and credit cards, better terms on mortgages, and even job opportunities. Conversely, a low credit score can limit your financial options and increase your costs. By understanding and managing your debt wisely, you can ensure that your credit score is a boost rather than a bust. Taking control of your debt is the first step towards a healthier financial future.